You've been investing consistently. Every month, you put money somewhere, a mutual fund, a savings plan, something. You feel responsible. You feel like you're doing the right thing. But what if I told you that a quiet fee, one most Nigerians never notice, has been shrinking your returns every single year? Not because the market crashed. Not because you made a bad decision. Simply because of how your investment is structured. Today we're going to talk about two of the most searched investment options in Nigeria right now, mutual funds and ETFs. By the end of this video, you'll know exactly what each one costs you, what each one earns you, and which one deserves your money. Julius is an accountant in Lagos. Pays his bills. Saves every month. For 3 years he's been putting money into a mutual fund, same routine. He feels like he's doing the right thing. One afternoon, his colleague Peter walks in from lunch looking unusually pleased with himself. "I just checked my portfolio," Peter says. "My ETF is up again." Julius looks up. "You're what?" Peter pulls up his phone. Julius leans over to look at the screen, and something shifts in him. Not because the number is huge, but because he suddenly realizes he has no idea what his own money has actually been doing for 3 years. That evening, Julius goes home and starts asking questions he should have asked a long time ago. A mutual fund pools money from thousands of investors and hands it to a professional fund manager. That manager's job is to decide where to invest, Nigerian stocks, bonds, treasury bills, with the goal of growing the fund over time. In Nigeria, you've probably seen names like Stanbic IBTC, ARM, Coronation, or FBN Quest. These are fund managers. When you invest with them, they charge you an annual management fee for their service, typically between 1.5% and 2.5% of whatever you have invested. On the surface, that sounds small. Almost invisible. Julius thought so too, until he did the maths. He pulled up 3 years of statements. Added up every fee deducted. And sat back in his chair staring at the total. That money was supposed to be his. The next morning, Julius confronts Peter. "How long have you been doing ETFs?" 2 years, Peter says. "Since I realized I was paying my fund manager more than I was earning above inflation." Peter explains it simply. ETF stands for Exchange Traded Fund. Like a mutual fund, it's a basket of investments, stocks, bonds, commodities. But unlike a mutual fund, nobody is actively managing it. Instead of a fund manager making daily decisions, an ETF simply tracks an index. In Nigeria, that could be the NGX 30, the 30 largest companies on the Nigerian Stock Exchange. When those companies grow, your ETF grows. Automatically. No manager sitting in an office deciding what to buy or sell. No expensive team of analysts. Just the market, doing what markets do over the long run. Because there's no active management, the fees are dramatically lower. We're talking 0.3% to 0.5% annually, compared to 1.5% to 2.5% for most mutual funds. But if no one is managing it, Julius says, how do you know it's performing well? Peter smiles. That's exactly what I asked. Then I saw the data. Over any 10-year period, research consistently shows that more than 80% of actively managed funds fail to beat their benchmark index. Meaning if your fund manager is competing against the NGX All-Share Index, which an ETF tracks automatically, there is an 80% chance you would have done better just buying the ETF. 80%. Julius is quiet for a moment. So I've been paying more, he says slowly, to get less. Peter doesn't say anything. He doesn't need to. 2 friends. Same income. Same discipline. Both investing the same amount every month for 10 years. One in a mutual fund charging a 2% annual fee. The other in an ETF at 0.5%. After 10 years, assuming the same market returns, the mutual fund investor ends up with roughly 15% less. Not because of bad luck. Not because of a crash. Because of fees compounding silently in the background, year after year, while nobody was watching. That 15%, whatever it represents in your own numbers, is money that was supposed to be yours. Julius spends his lunch break asking Peter everything. So should I pull everything out of my mutual fund right now? Peter shakes his head. Not necessarily. Mutual funds still have their place, you just need to know when that place is. If you are brand new to investing and want something completely hands-off, a mutual fund is a reasonable starting point. Platforms like ARM and PiggyVest's investment feature make it easy to begin with very little. If you need somewhere to park emergency funds, money you may need access to quickly, a money market mutual fund is excellent. It invests in treasury bills and short-term government securities. Low risk, liquid, and earns significantly better than a regular savings account. And if you're just starting out and investing a very small amount to build the habit, the fee difference isn't going to change your life yet. Consistency matters more at that stage. Mutual funds are not the enemy. High fees on long-term investments are. So how do I actually buy an ETF? Julius asks. Peter walks him through it. First, open a stockbroking account. Platforms like Shaka, Trove, or any NGX-registered broker let you do this online in under 10 minutes. Second, fund the account, just like any investment app. Third, search for your ETF. On the Nigerian exchange you'll find options like the Vediva Banking ETF, the Lotus Halal ETF for faith-conscious investors, and New Gold for gold exposure. Fourth, buy your units. Choose how many, confirm the price, place the order. That's it. No fund manager. No annual percentage quietly leaving your portfolio every year. Julius opens the app that same evening. He doesn't move everything. But he starts. One decision, made with information he simply didn't have before. And that's the point of this video. Both mutual funds and ETFs can grow your money. But they do not cost the same, and over years and decades, that difference is the gap between building real wealth and building someone else's. Look at whatever you're currently invested in and ask one question: what am I paying in fees, and what am I actually getting in return? If you can't answer that, that's your sign to dig deeper. Share this with someone who invests but has never asked that question. It might be the most valuable thing they see this week. Subscribe to Smart Money NG. New videos every Tuesday and Friday. See you next time.